So welcome everyone into DeFi section. I would just say at the beginning that not all of us spent 6 years playing World of Warcraft during high school. But jokes aside, let's talk about DeFi. Do we have? So it feels for some of us that DeFi has been here with us already for a couple of years, but the truth is that DeFi has been here only for 2 years. The market has changed significantly. Historically, the DeFi was mostly about lending. It was mostly about one protocol called Maker, which were issuing the stable coins in exchange for collateral. Currently, the market is much more broader and much more bigger. Total value locked in the end of 2021 was $240 billion, almost. And we still see big opportunities. Currently, more than 1/4 of the market is in decentralized exchanges. But we see still growth in current verticals like lending. We see potential in mortgages, in credit cards. We see potential in decentralized exchanges to grow into also other markets like FX, commodities. Currently, big and interesting topics is actually derivatives, which are fully decentralized and permissionless. But we also, as we already talked about, we see DeFi in gaming, and we see some professions which will be fully replaced by blockchain, like notary. Currently, the DeFi has around 4.5 million users, but we have everything in place already for broader adoption. We have KYC. People actually think that when you enter a DeFi space, you don't have to have KYC. That's a myth. You have to have KYC. You always go through centralized entities like Binance or FTX, and these companies, they do KYC on you. They check your IDs with national registers. They check if you are not on sanction list. So there is no way to avoid KYC by entering DeFi space. We have speed. Visa performs around 24,000 transactions per second, and Solana, it's faster than that. But what is most important is the settlement time. The settlement time is in seconds, while in traditional finance, it's more like 1.5 months you have to wait for your money. We have low fees. Of course, on Ethereum, the fees are in general higher, but there are many scaling solutions. Marek will talk in his section about it a bit into more detail. And we have securities. You have protocols which has been here for longer than 2 years, and they never have been hacked. They performed several security audits, and I think they are very secured. So why we have only 4.5 million users currently, and the number doesn't grow that much? I think from the retail perspective, the problem is still with fiat or ramp. It's quite difficult to get money in crypto and out of crypto. You have to go through several bank accounts. You have to go through centralized exchanges to actually get to DeFi. So I think this is one problem. Second problem, it's complexity. DeFi, it's very complex still. You have several layers. One, which do not communicate very well between each other. You have to know which bridge to use. And if you make a mistake, you lose all your money. And as we talk about already, blockchain is still not user-friendly. We have to make it more like iPhones, so people wouldn't even know that they are using blockchain technology. I think from the institutional point of view, we still need more education. This is also why we are here, because crypto had historically quite wild periods, and people are afraid of it. They don't understand the risk. They don't understand the opportunities. So we are here to actually explain what's going on. I think we would need something like rating agencies, something what Moody's did for bond market, so the institutional investors actually would feel comfortable. I think it would unlock huge unsecured lending for the blockchain technology. And we need better custody solutions. Basically, you have no one custodian on the market which would cover all the layers one and have comprehensive solution. So, and this is also the areas where our VC focus on. Additionally, we definitely need regulatory clarity. I can tell you from our experience, and Victor already mentioned that, I spent 9 months creating fully regulated fund. I spent first 3 months only talking to regulators, talking to lawyers, where we can actually launch the fund. and the only possibility in the end of the day was Liechtenstein, the only place in Europe where you could actually do it. And then we spent additional 4 months on looking for the right administrator and what's most important about right custodian. It was much more difficult, actually, and took much longer than we initially expected. So what do we do? 30% of our portfolio, it's invested in CeFi. We mostly provide loans to market makers like Dexterity. We invest in market-neutral funds. But what's more interesting, I think, is our DeFi section, which is around 70% of our portfolio. Our portfolio basically reflects the market structure. So we mostly invest into DeFi lending. We provide liquidity to decentralized exchanges. It's important to say that all our strategies are based on stablecoins, so there is no volatility on the investment. When the volatility comes, it's usually on the yield side. And this is basically influenced by several factors. For example, now we are in kind of bear market in crypto, so the yields are in general lower. It also depends when you invest into the protocol. Of course, when you provide liquidity to protocol, which is young, you can generate higher yield. Of course, the risk is also higher. But then you have to have a knowledge and a team who would help you to analyze the protocol and tell you that everything is good, that you did your due diligence, and that you can generate higher yield. This is where we actually generate alpha. We cooperate with the VC team, so we are very early into those investments. If you are interested about our strategy, I'll be more than happy to talk to you about that during a coffee break. But now let me introduce our guests. Michael Morrow, the CEO of of Genesis. Michael Safai, the founder of Dexterity, and David Fauchier, portfolio manager of Nickel Digital. So maybe if you could just introduce yourself, what you do, what is the main part of your business for our audience, and then we can talk more about DeFi and CeFi.
Sounds good. Hi, everybody. Michael Morrow, CEO of Genesis. We are an institutional prime broker within kind of the crypto ecosystem. We have been around since early 2013. We have a trading business that focuses on spot as well as derivatives. We have a lending and borrowing business that we think is the largest globally at about $14 billion of loans outstanding today. And then we have a custody business where we're now holding on to funds and crypto tokens of our clients. We have about 200 employees today. We are headquartered in New York, but we have offices here in London as well as in Singapore. Pleasure to be here.
I'm Michael Safai. I'm the managing partner at Dexterity Capital. We're a proprietary trading shop that executes market-neutral algorithmic strategies against cryptocurrency, so lots of low latency, high turnover trading. And we've been trading 24/7 for the past 5 years.
Hi, I'm David Fauchier. I work at Nickel Digital, which is a crypto-focused asset manager based in London. It's got a number of different products, but I run one of those, which is a multi-manager fund focused on market neutral.
Okay, so thank you. We talked about it also before, but you all guys are more focused on CeFi. So what opportunities and actually problems do you see in DeFi, and why you are not more involved, and what would have to happen for you to get more involved in it?
Yeah, we were chatting right before the panel as to why there's 3 CeFi dudes talking about DeFi at the conference. But at a high level, there's a few things certainly within Genesis that we're doing as it relates to DeFi. The number one thing, because we're working primarily with institutional investors, many of them are crypto native, but others are kind of more in the TradFi space. Because of kind of our client segmentation, naturally the TradFi guys are going to be slower on the uptake around DeFi. Lots of questions, lots of doubt, frankly, still kind of exist amongst them. The crypto native guys, they're very active. We've traded just over $1 billion, I think, of kind of DeFi tokens last year, which $1 billion is great, but we traded over $100 billion of kind of like everything else, and so it's a small percentage of kind of the Genesis flow. At the same time, the crypto native guys are able to comfortable engaging kind of directly with the platform. the TradFi guys are like, what's a MetaMask and what am I doing, right? Like with holding funds in a web browser. So there's a ton of like education we still kind of need to do. One of the roadblocks is, and we talked about, kind of smart contract auditing, but like the TradFi guys are used to TradFi things. So like insurance, right? Like third-party insurance around smart contracts, they don't want to audit code, and so they'd rather kind of buy a policy from someone that is going to guarantee that their funds are going to be okay regardless of what happens, and certainly pay a price to kind of get it done. I think there's kind of tremendous progress ultimately to be made there. And three, like, it's funny, Adam was just kind of going through his presentation about, hey, we have KYC. That layer exists. It's funny, I think one of the reasons growth has slowed is that KYC. Yeah. The more you kind of create friction into the ecosystem, the less likely folks are like wanting to kind of participate in it. And so, as we kind of layer in enterprise grade solutions and products, I think, in the ecosystem, I think it'll make kind of the TradFi guys certainly kind of happy, but the crypto native guys start kind of going in the other direction and almost be like, all right, been there, done that, what's next? And kind of their attention might, potentially kind of go elsewhere. I do think that the yield play, like the role of DeFi originally is like, well, it's to make me rich, right? Like, with the 1,000% plus kind of like APY worlds, and while I think certainly kind of yields will come down, I think subsidies have to kind of go away. I do think we're kind of in this world where, you've seen DeFi 1.0, we're now waiting for the 2.0 phase, and you're kind of in the building phase. And, one of the earlier panels kind of talked about how finance kind of got forgotten, right? I think it was Barney's comment that finance got forgotten in the birth of the internet. The whole promise around DeFi is kind of the taking out the middleman, being able to do things kind of directly, and taking out entire companies out of the entire value chain, that results in sort of efficiencies across the curve in terms of time as well as dollars, right? That is the promise of DeFi. That, I think even the TradFi guys agree, is fascinating. I think that interest is certainly there. But the product itself and what that looks like and what it ultimately means is still kind of being figured out. And so that adoption around, kind of the traditional investors, I think will wait until the products kind of exist. But that's still kind of, I think being developed, I think, in my view.
Yeah, I think you're right on there. There's a ton of friction in trading DeFi. And as prop traders, we love retail flow. So when there's friction, retail traders don't come. We've been in and out of DeFi trades for the past 5 years. And it's funny, we're still using MetaMask. We're still using wallets like that. And it's amazing technology, but for a neophyte, it's really hard to get into. And getting into this world where everything is a 40-character hex address is really intimidating. So I think eliminating that friction will do a lot towards driving user adoption, and that will get us more excited about it because we'll see more flow as people use these really cool applications. So I think that's something we'd love to see change. I think another problem with it is DeFi just has this rich lexicon of weird words that nobody knows in the traditional world. So it's a very steep learning curve to get into it. And there's a wealth of different trading venues, and there's a ton of different types of products that are actually novel and haven't existed before. This complexity keeps kind of the retail user away to a certain degree. So while we love having a lot of venues to trade on as professional traders, and we love having lots of different products, I mean, some consolidation would actually be good for adoption. So it's kind of a double-edged sword for us, but I do kind of hope that's the direction it goes in.
I think on our side, we weren't as smart as Michael, and we took other people's money. And when you take other people's money, it comes with a set of constraints, as it should. But like one of the things we've really been battling for the past 6 months, as DeFi becomes a bigger and bigger piece of the strategy set, is custody. And like, how can you put in place a custody solution that can guarantee back to your investors that you can't run away with the money, it can't get hacked, and that there is a custodian that's controlling all of this and whitelisting where you can move these crypto assets to. That's been a real issue, as has pricing, as has audit. And these are sort of non-monetary reasons that are blocking, I think, large pools of capital, including ours, from participating more fully in the space. And what you can do today as a crypto funders do a lot of the kind of plain vanilla DeFi stuff, the things that are, on Zappa, are discovered, are supported by Wallet Connect or MetaMask, et cetera. But as you get to the more kind of juicy and interesting stuff, it gets progressively harder and harder. And there's this kind of wonderful quote in Margin Call, a movie that came out. And I think like the CEO is sitting at a table and he says, like, there are 3 ways to win in this game. You can be fast, you can be smart, or you can cheat, and we don't cheat. And while we like to think we're smart, it's just so much easier to be fast. And I think this has been true in the crypto space, certainly, and we've been kind of seeing this over the past 4 years. Being fast, the spreads are just crazy wide, and the easy money is there, and things just tighten as more and more and more people move into the space. And there's this kind of broad move that's been happening of more and more traditional money, and therefore larger amounts of money moving into CeFi, and prime brokers actually moving into the space, the big prop shops moving in, and that's sort of pushing a lot of the yield opportunities out into DeFi. And then in DeFi, it just, as you progressively kind of climb that ladder of complexity for anyone that's trading other people's money, the opportunity set kind of gets bigger.
Okay, so what I'm hearing is that everybody expects that the yield in DeFi will go down as we progress further. Is that right?
Like you had a great slide. I think the trade that was making 20% last year is going to be making 10 or 5% this year.
I mean, then you kind of, I think, have to move liquidity from one protocol to the other, and you have to be early. But what I see is also when you provide liquidity and you have protocols which gives you tokens for that. For them, it's also sort of marketing. They need that. They need to get big. So of course they need to give you something. And I think this kind of marketing expense will stay there. I think this is actually what Anchor did recently, right? I mean, they're still keeping the fixed rate around 19.5%. And even though they have to subsidize the yield, they're doing that because everybody is talking about it. The whole crypto community is talking about it, that you can generate 19.5% there, while the yields everywhere else are much lower. So I think for them, it's really just, marketing expense. So I think this is also maybe a way how to look at it. I don't know if you agree with that or what's your thoughts there?
Agreed, certainly, to kind of get initial traction. But it's also one of these, how sustainable is it to continue to pay out 19.5% into perpetuity? Yeah. Or even sort of, even a less period, even for 5-10 years. And so, at some point, that has to kind of come down is kind of one view. The other view, when it kind of comes in terms of yield, is when I speak to traditional investors, they equate rates with like risk, right? Higher rates equal higher risk. And therefore, I actually like to take lower risk. And so they actually search for lower ones because they think that that's kind of the safer investment. I think the hard part is you can't not do like risk-adjusted returns kind of in DeFi. You can't really say, hey, one is paying me 10%, the other's paying me 15%. Why is the other one paying me more? And be able to say, hey, on a net risk-adjusted basis, it's actually the same or one's kind of better. You can't do that analysis. So you just kind of pick the gross highest earning yield and say, hey, I'm just going to yield hop that way, kind of on that side. But from a traditional investor's perspective, they'd rather invest in something that would probably pay you 10% than something that pays you 1,000%. Because they'll just equate that 1,000% as like definitely something is going to go wrong. And that like the DeFi space, I think, kind of runs that risk of kind of, being painted with one broad paintbrush as being like crazy, risky, insane. Whereas kind of the warm and fuzzy feeling is right around kind of that high single digits to mid-teens at the highest. Any higher than that, you go, oh gosh, this is high yield, I can't play there.
Yeah, I think, when I think about what Anchor's doing, yeah, they're spending a lot of money, but that's not exactly crazy. It's cost of acquisition, customer costs, right? How much does it cost to get a new user? Because look, they're battling Ethereum, the granddaddy, who already has a massive pool of developers and products, and they're going blow for blow with guys like Solana, who also have just a lot of backing, a lot of developers, and a lot of cool kind of applications. So it does seem like a bit of a race, but it's something we've seen in the traditional world. And you can take Uber and Lyft, both which are car share providers in the US. They were just given rides at an absolute loss, and in fact, they may still be, I don't know. But this is what it cost them to fight the war. This is what it cost them to get users on board. So I don't think it's nuts, but they do have to deliver. They do have to get that really strong core community that's going to last when those yields eventually come down.
Okay. David, you said at the beginning that there is less and less yield actually in the, let's say, more traditional part of CeFi, and that everybody is moving to DeFi. And you're running a fund which is mostly, in the CeFi space. So, how do you deal with that, and what are the ways actually how to improve the yield for you?
That's sort of my very high-level perspective over kind of a multi-year period. I think 4 years ago, when market neutral was just starting out, if you looked at the futures curve, it just basically wasn't a curve. It was just random dots on a chart. That got arbed. That was wonderful. And there's this sort of very long ladder of complexity of trade that you can climb to preserve the return. And then at some point, presumably, there will be the ability to add more leverage to that. Those are the two kind of big levers on the CeFi side. But yeah, broadly, I think the simplest trades get eaten up, and there's only so much capacity in each of these trades, and capital comes in, and it just picks off the easiest and then the hardest. And I think on a broad kind of multi-year view, CeFi is going to get picked off before DeFi, and easy DeFi will get picked off before hard DeFi. If we look down to kind of quarter to quarter, month to month, I think it's very kind of multifactorial. Yes, crypto markets trend towards more efficiency over time, but there's a huge modulation around that trend line that's driven by, if we look at the past 6 months, less retail involvement. That's the main one. We took out China retail in one go, basically over summer. That's been big. Entrance of prop shops, PBs that will allow you to cross margin. There's all sorts of things that have happened in the space that are affecting this. But we're one bull market away from basis blowing out again and the market being inefficient again. So I don't think these opportunities are gone forever. I think that on the easy trades, we will see kind of a feast or famine dynamic. And on the harder, more capacity-constrained trades that fewer people can do, there's going to be steadier returns on those.
Okay, thanks. Does somebody from the audience has questions? So I don't leave it at the last moment. No? Okay. Michael, you said interesting thing that KYC actually slowed down the whole market. Mm-hmm. But isn't it more the long-term game? Because I don't think we can move forward without KYC, especially if you want to connect the traditional world, with blockchain and with crypto. You need KYC. So, and the blockchain can actually make the transactions much faster. I think this is the added value. But you are not going to lend anyone if you don't know who is this person, and if you cannot actually connect the loan to his real-world assets, because maybe he has enough NFTs in his wallet, but maybe no. So isn't it just, maybe slow down, which is here just for some time, but it actually will help the market in the long term?
Here's my view. Obviously, there's an addressable market of everybody that wants to be in crypto or is currently in crypto. And the guys that are willing to be KYC'd AML, there's a subset of that total population, right? So yes, so you're already eliminating, I don't know what the percentage is of people that are willing to be verified versus not, but it is going to be obviously be smaller in a percentage. And kind of within that pool, yes, certainly I run a regulated business. And so yes, the fact that every counterparty is AML KYC'd is certainly music to not just my ears, but my regulators' ears, right? But ultimately the question is, working with, lending pools, for instance. We already know most of the, kind of institutional lenders and borrowers kind of within the crypto ecosystem today, kind of throughout our business. When we bring that to kind of the AML's KYC DeFi platform, kind of the permission pools, how many people show up and how many people are people we don't already know outside of that pool, right? Because then you're really talking about, if we already know everyone that is showing up to a permission pool, then what's the value of the permission pool? And so I do think today, a lot of the pools we do, we already know everyone that's kind of in it. We just kind of use some of the DeFi protocols as almost kind of the settlement layer, right? Where you're kind of agreeing to the loan or the trade offline and just settling it on the platform. while that helps, certainly from kind of back-end office type of stuff, that's probably a little bit more removed from like the future and the promise of DeFi. But the hope is the AML KYC environment will allow and kind of provide a lot more comfort for more of the traditional investors to kind of get involved. But frankly, a lot of the guys that I'm still speaking to are like getting comfortable with Bitcoin and Ethereum. So DeFi and permission pools and things like that is probably a couple of years away.
Okay, makes sense. Michael, Dexterity actually, how many trades do you do per day?
Oh, per day, a few 100,000.
Yeah, so I think you see the best, actually, the liquidity on the market. Do you think that the liquidity comes mostly from within the crypto ecosystem, or we actually have inflows from outside the world? Because what I'm hearing a lot, people are asking me, and I don't really know the answer, is how much of the inflow it's coming from the, let's say, traditional investors, and how much is just, that the price went up and people are just trading more. So maybe you could, help us to answer the question.
Yeah, it's a hard question to answer. I think, what we've seen is cycles, because we've been doing this for a few years. And when you had the bull run in 2017 and kind of the beginning of 2018, you saw more money coming in from new places, and a lot of big brand name institutions started talking about getting in, but then things cooled throughout 2018. Everyone stopped talking about it, but still there was a lot more activity even during the so-called crypto winter than prior to the bull run. And now we're in a phase where we've seen institutions now publicly come in during this last bull run. And while things may or may not be cooling right now, we'll see how long that lasts. But I imagine this year, even if it's a cool year, is going to have much more volume than we saw in 2019 or even 2020. So there's definitely funds coming in from institutions. In terms of the trade flow we're seeing, it's kind of funny. There are some venues where it's pretty clear it's professionals trading against professionals. And there's other venues where you're seeing professionals trade against retail. And each one kind of has its thing, and we've seen that move from time to time as KYC requirements changes, as regulations change in each jurisdiction. There's this bit of a cat and mouse game of where flow actually goes. It's not something we've done a super deep analysis on, so I can't give you a great, strong answer, but it's definitely a phenomenon we observe kind of happening. But things still look good. I think we're still seeing more money come in wherever it's coming from. And whatever happens this year, we'll see, but the next bull run will even bring in that next layer of kind of sophistication.
Okay. Let's see. Maybe also, David, from your perspective, do you see the same investors all the time, or do you have some new investors, into the fund? So you would see that actually the traditional finance money are entering more the space.
There's certainly, we spent everyone spent all of 2017 and then 2018 and then 2019 and then part of 2020 saying, the institutions are coming and there's a wall of capital coming. I think that actually arrived somewhere around summer of last year. People stopped talking about it, stopped educating themselves, and actually started allocating. And we saw an enormous inflow, both to ourselves, but just like the broader fund ecosystem raised a huge amount of capital across venture, market neutral, hedge funds, closed funds, like you name it. Like the amount of institutional money that's come into the space has been huge. And the amount of money, I think Michael might shed more light on this, but the counterparties that you guys are facing versus who you were facing 2 years ago is drastically different, and the kind of clip sizes that they're talking about are drastically different. And I would guess, aside from the traditional hedge funds, a lot of that flow maybe has been one way over the past 2 years. So there's fresh money coming in, but there's a huge amount of kind of crypto trading. And to Michael's point, yeah, there are venues where it's professionals against each other in very tight markets. And you look at, I don't know, Huobi is an ex-Chinese exchange that offshored after the troubles with China, and they cut all of their Chinese user accounts by October 29th. It was a huge kind of furore. But they've been spending huge amounts of money, like trying to pick up retail traders across the rest of Asia, ex-China, for the past few months, and just trying to kind of fill that funnel. And this is a model that kind of exists if we look at the, what are they called? Plus 500, IG, these like CFDs, contract for difference platforms, where it's like for retail to go and trade on, and they spend a lot. A lot of these are public companies, and you can see like they're wildly profitable businesses, but they spend a huge amount on marketing. They get kind of retail traders in with very small amounts. According to the FCA, this is on every advert for a CFD platform, like 87% of people lose money. But this is another form of gambling, and people enjoy gambling, and there is a real spot for it. So I think the crypto market is sort of one part. When money comes into crypto, it usually stays there, and the people that are there like to gamble often. And then there's a kind of, I think, a real sort of real economy kind of venture piece to it, where people are building real technology. And then you have the new sort of inflows into like Bitcoin, Ethereum, and the kind of buy and hold.
So this creates the imbalances on the market, and then if you're
These
kind of
things
market
will-
maker, I guess you can also, or trading market neutral strategies, I think this is the imbalances you exploit.
So all of these things are interfacing with each other. It's very multifactorial, like I was saying, but ultimately we have like 10 crypto exchanges that really matter, and each of those has their own order book for Bitcoin dollar. And they also have an order book for Bitcoin dollar futures and Bitcoin dollar swaps, and they have, for futures, they have the inverse and the linear futures, and the same for swaps. So you have this huge kind of fragmentation of order books across the whole space. And this, as people trade against those order books, it creates pockets of liquidity and kind of air gaps in that liquidity. And this causes dislocations, and this is where people like Michael and I kind of step in to fill those liquidity gaps.
So you don't think that the market just became more efficient, you just think that there is less retail money right now?
I think it's getting more efficient as a trend line, but retail disappeared, and that was the number one factor in spreads tightening over the last 6 months, for example. Okay. And if we had another proper bull market and retail participated in that, the market would get very noticeably less efficient again, I think. Okay. So this is not a kind of one-way.
So we need to invest more into marketing for retail. I'm joking. Dushan, you had a question? You were. I don't think we can hear you. If you can maybe.
Maybe we.
Hello?
Yeah.
Okay, cool. So, hi everybody. Hi David. Hi both Michaels. I have a question in terms of the returns that you are seeing on the market in the algorithmic trading companies. So what we have been seeing is quite good returns in the market from our view. Like there were market neutral trading companies doing like 10% month-on-month basis, maybe even more. And that lasted until I would say December or January. And since January, it feels like the returns has diminished to very minimum. And right now we are looking at the trading companies achieving maybe 1% per month. And that's a drastic jump. Have you been observing similar performance, I would say, decreases or efficiency in your trading strategies over the course of last 2-3 months? Or is this just our like bias on?
Yes. Definitely. Really, like especially since the 4th of December, we had a big crypto crash, and after these crashes, you tend to get sort of a reset in the market regime, and everyone sort of fiddles with their models a little bit, and things start to pick up afterwards. Everything arbitrage and strictly market neutral has been very tight since kind of mid-December onwards, for sure. Like basis is very low, it's very flat. Volumes have been going down for a few months now. Yeah, it's been tough conditions in kind of market neutral and arbitrage and HFT. There are less people kind of willing to cross the spread. People are patient about moving into their positions because prices are quite range bound. So this affects things like market making, where it just takes longer to turn your capital. And then as we look onto kind of stat arb, RV, these strategies have basically done fine. These are 1.5 sharp strategies that had a kind of infinite sharp return component bolted onto them in the form of like, they would just like short the perp against that coin, for example. And they were using coin margin contracts to put their positions on. And so they were collecting like 10, 20% in basis or funding rates per year. And so they have a 1.5 sharp strat plus something that just makes money every day. And so when you put those two together, you get a kind of 2.5, 3, 4 sharp strategy, which actually is kind of a 1.5 sharp strategy. And as that basis has dropped off, the variability in those returns we've seen across all the managers we're looking at really start to show. And because you're 1.5 sharp strat, it's just difficult to figure out what's noise and normal expected variability versus market conditions versus alphas actually degrading. And then the final piece for us is DeFi, and DeFi has basically ticked along. Lots of money has moved into the space. As the price of these assets has dropped, your kind of yield farming yields have come down. So if we kind of put the whole picture together, there are some kind of more creative ways of making money. But I think in size, it's certainly been more difficult in the past few months. And this looks a lot like the H2 2019, when we had a wonderful start of 2019. And then in June of 2019, we had the Libra announcement, Bitcoin peaked, markets started tailing off, then crashed. And we had an extremely slow 6 months where nothing happened. And everyone was saying, basis is over, these trades are finished, crypto markets are efficient, we need to find a new job. And then we had an extraordinary, like January and February of 2020. March was March, but then April 2020 through to really summer of last year was an extraordinary period. So we had pretty much 18 months, almost back to back, of wonderful market conditions where market neutral funds, prop shops were making more money than they'd ever made.
Yeah, I mean, David mentioned basis, kind of as a market neutral play, kind of arbitraging kind of the spot and the futures market. Like at times, like you could, without taking a directional bet, you could earn like north of 30%, just arbing kind of the spot and the futures market. Because of kind of the capital inefficiencies and relative liquidities and kind of the difference between the two. And when bull markets kind of, or you see bullish movement, like the futures blow out way faster than the spot market does, kind of giving first movers kind of the ability to kind of execute, buy one, short the other, and kind of wait till expiry strategy. And to David's point, like my sense is if we were at like Bitcoin 80K and to 100K like in the last like 3 weeks, this whole narrative and panel and everything that's happening would be vastly different because I expect those same returns to come back, that same trade will still be there, funding costs will blow out, and like we're all like in a much different space, and I don't today kind of see that like capital efficiency and the ability to arbitrage being gone in kind of the next bull cycle. I think it'll still be there. It's just kind of the market sentiment we're in right now, where like, everyone's down, everyone's like, this is awful, right? And Bitcoin is still whatever, 40K. Like, so we would have taken this bear market, welcomed it, and called it a bear market, not too long ago.
And it has been just 6 months, so it's crazy. Some other questions from the audience? Yeah, we have there.
Thanks. Just your point of view, how much business or trading is done on OTC today? I think only 50% of Bitcoin are listed on exchanges. When supposedly today some like rich Russian guys are selling 2 billion Bitcoin, we don't see it, in the prices. So how much trading is really actively done OTC, and what impact on what is the real premium, I would say, between OTC prices and the one on the listed markets?
It's hard to tell you exact numbers, certainly. But my view is, a place like us, like somebody might come, well, first of all, there's never been an actual trade like north of like $1 billion. Like that's just a rumor that exists on the internet. There's no like crazy buyer that wants to buy $3 billion worth of Bitcoin in 2 weeks. That whole thing I think is a scam and a myth and all of it. Having said that, there are guys that'll come in that'll buy $100 million over like 4 weeks. Okay, they'll TWAP whatever, 25 million a week and own a $100 million position, or the other way, kind of on the way out, try to sell everything. These guys still care about market execution. They don't want to crush the market, and so they're not just going to outright dump ultimately in the marketplace. But like every OTC ends up hedged somewhere kind of on the exchanges. So while you might not see the original like $200 million flow, you might see that'll bleed out as kind of the market makers kind of hedging it over the 4 weeks, right? And so the flow ends up on the exchanges anyway, even if that original big print might not be there, if that makes sense to you. And then certainly there are guys, because now there's a lot more instruments to hedge your Bitcoin spot risk. you might not see that whole thing kind of played on the spot market either, because guys might take out options or trade futures or whatever it is to kind of get out, rather than like just taking $100 million and like, you know, spraying and praying across the exchanges, if that makes sense.
How many Russian oligarchs are you selling Bitcoin to?
No, thankfully.
Good answer.
Thankfully, no. Thankfully, none. But I appreciate the question, David.
Some more questions? Okay. Michael, we also wrote, or we were talking about it also before. As I said, you are mostly focused on CeFi, but you said that you seek some opportunities in DeFi, arbitrage opportunities. Can you talk about it a bit more? And why don't you do it, or do you do it already, or you are still looking at it, or you know, balancing basically locked liquidity into some protocols because they are trading below the net asset value and.
Yeah, I think it's a really interesting dichotomy between CeFi and DeFi. They are dramatically different ways to trade, especially as a prop trader. Structurally, they're just whole different beasts. When we look at DeFi, I mean, everyone knows about liquidity pools and, you know, staking and yield farming and all that good stuff. And that's an interesting opportunity as well, because it's actually highly manual. What we do is fully automated, and it's just a real technical burden and required years of development. So it's a whole different thing to tackle. That being said, I've seen some really cool, unique opportunities in DeFi lately that aren't just staking. You've got these funny situations where there's a price of a token, and that token has an underlying treasury, and if you mark that treasury to NAV, it's often above what the token price is actually representing. And if you've got the stomach for it and you can bear it out, you can actually do quite well just sitting on the token and waiting for that treasury to either pay out or for the price to come back in line with it. And we see this in the traditional world too, but because crypto is very sentiment driven, and more so than the traditional world, you see larger disparities between token prices and the underlying treasury NAVs. So that's something we've seen a lot of. Another cool thing that has been happening is kind of miner extraction value, or in the old days we'd call it mempool sniping, where you're watching what transactions are coming in on chain and then making very strategic transactions around those to generate alpha. This is actually really hard to execute, by the way. It's much harder than just yield farming. But it's a whole different skill set than what you'd build for a traditional kind of HFT, CeFi shop, or TradFi shop. Those are places that we see opportunity, and for us, we kind of tackle them opportunistically. We're always comparing how much bandwidth do we have as a team, and what are the respective yields and what are the respective risks. So for us, we get in when it makes sense, and we get out when CeFi is just doing better and it's a lower lift for us.
All right, sounds good. Sounds interesting. Okay, since we have already only like 2 minutes, I have the most difficult question for the end. What do you think has to change so we get again into the bull market? What is the trigger?
What are you looking at me for?
I have felt twice in my life, in the past 10 years, I felt twice that, like, specifically on Bitcoin, like, if not now, then when? One of those times was post-COVID crash, when central banks just stepped in size and we started getting stimulus checks. Like, if not now, then when is Bitcoin going to hit an all-time high? The next one is now, if things play out like they seem to be playing out, you don't just confiscate what used to be a G8 country, central bank reserves, and then expect everyone to continue using the dollar, I would think. If this ends up being true, surely the only, real bearer asset that people can buy is gold. And I think if gold goes to the moon, Bitcoin does as well. If Bitcoin does, crypto does.
If I can step in, but Russian central banks also cannot sell their gold right now, right? Nobody wants the gold. So there's also...
The same would be true, to be fair, of Bitcoin. It would be difficult to sell $10 billion worth of Bitcoin without anyone knowing.
Yeah, I think 2021 was just a perfect storm of peculiar circumstances. You had celebrities like Elon tweeting about crypto all day long. You had this narrative as inflation was creeping that maybe you should have a hedge in crypto because your dollars aren't going to be worth as much. And then, of course, you had COVID, so people had more time to sit at home and trade. All those things coalescing at the same time, no one could ever have predicted, and it made last year a massive year. And that wanes. That's what happens with these kind of, if you want to call it a mania, they wane over time. And I think that's okay here. This is a cycle. You have to be in it for a long game. We saw the same thing in 2018, where things went to the moon, things cooled, people went back home and built lots of cool new applications, and that drove kind of the next bull run as all these other circumstances kind of circled around them. So I can't tell you when things will change or what's going to drive it, because I definitely didn't predict what drove last year. But I think it's going to come back, and the money that's new, is probably going to stay there for a long time, and it's gotten to be such a big asset class, it'll be very hard to kill.
I'm historically bad at this, so please take everything I say here with a grain of salt. But from a personal sentiment perspective, like, there is nothing that can make me more bullish about Bitcoin than kind of what's happening right now and what we've seen. I think the petrodollar is potentially dead here. I do think that the narratives that we've certainly seen it'll play out kind of, especially kind of at the macroeconomic level, and inflation at 8% back in the US and all of it. We had so many investors and people saying, hey, the thing you were telling me about in 2013, I get it now, right? Like, once they start to live and experience it themselves, they start to get why you were drinking the Kool-Aid when whatever, Bitcoin was at $80 or something when I was trying to sell it to them. So my guess is it'll be late next year, is my sense, kind of heading into the next halving, which always kind of tends to be a price catalyst. I do think that we'll see kind of prices in kind of range bound for most of this year. But I do expect kind of heading into the next kind of Bitcoin halving towards kind of end of next year is when I would expect kind of that new all-time high.
Okay, sounds good. Thank you very much. It was a really good discussion. I think, Mark, we have a coffee break now. Okay, so I think we have a coffee break, 20 minutes. Till 3, and then we will come back. Thank you very much. Thank you, guys. It was really good.